saving early for retirement can have a huge impact on supporting a nice retirement lifestyle in your later years. And many adults, young and middle-aged alike, get that. But at the same time, not all adults are working for companies that offer employer-sponsored retirement savings plans, like a 401k or a 403b. So how do you start saving? One option is through traditional IRAs, and this video is here to help you learn more about these lovely gems. Hi, I'm Donna Kendrick of Septon Financial Services, and welcome to Widow and Wisdom, Your Wealth Edition, a video series for families in transition. This video series is for the listeners whose tomorrow is very different from their today. Whether it be through widowhood, divorce, or career change, this series is made to help you figure out your new tomorrow. So let's talk about tax-deferred savings. Funds in a traditional IRA accumulate tax-deferred, meaning you don't have to pay taxes on the funds until you start taking withdrawals or distributions in retirement. The hope here is that you will be in a lower tax bracket during retirement than you are right now. Withdrawals will be taxed as ordinary income. Now there's a catch. If you take funds out before 59.5, the funds will be taxed at your ordinary income tax rate plus a 10% penalty. There are exceptions like disability or first-time home purchase and a few others. Always consult with a qualified tax professional before taking out an early withdrawal. Otherwise, you must start taking withdrawals by age 72. These are called RMDs, or required minimum distributions. Now, we love tax-deferred savings because a bigger amount, since taxes have not been withdrawn yet, can grow and compound year after year. Another important point is that traditional IRAs are tax deductible. Each year, the government tells us what our contribution limit is. For 2021 and 2022, if your earnings are in line, you may be eligible to put up to $6,000 into a traditional IRA. Now, if you're over age 50, there's another $1,000 catch-up. Now, there are some rules, because what is life without rules? First, if you're an active participant in a workplace retirement plan, your IRA deduction may be reduced or not allowed. Second, there are income limits. For example, if I am single and my modified adjusted gross income, or AGI, is $66,000 or less, I am eligible to receive a full tax deduction. If I am single and make more than $76,000, I am no longer eligible for a tax deduction. Complicated? A little. Non-deductible contributions make things even a little bit more complicated. And a word of wisdom is to track those contributions well, and perhaps even open a separate traditional IRA to support those savings, or highly consider a Roth. Now, we will be making a Roth video soon. Traditional IRAs can be a great way to track your retirement funds. Why do I say that? In the era of getting one job at age 18 and staying with one company until you retire is pretty much seen an end. Many of my clients in their early 40s have had 5 to 8 employers in the last 20 years. Imagine that each of those employers offered a 401k plan. Keeping track of each of those plans and making sure all the funds are invested towards your goals and risk tolerance can get complicated. You have the option of a rollover into a traditional IRA, so you can consolidate all of the accounts. There are no penalties or tax charged for a rollover. You can have all funds invested into one traditional IRA, one portfolio, and you get to choose your investments through a wide variety of options: stocks, bonds, mutual funds, cash equivalents, real estate, other investment vehicles. You won't be limited to the varying employee plan investment options. Now, before making the decision to roll your funds, consider the cost of the different types of the available accounts and the investment options offered. Remember, you can also roll those funds into your current employer's 401k. Now, please do be sure to speak to your financial professional carefully and consider the differences between your company's retirement account and the investment in an IRA. These factors include, but are not limited to, changes in the availability of funds, withdrawals, funds expenses, and fees. Now, I hope you've liked this brief overview of traditional IRAs. And the main thing to remember about traditional IRAs are the tax deferral of funds, which includes the benefit of compounded earnings and hopefully a lower tax bracket of withdrawal and retirement. The tax deductible contributions, lower your taxable income, keep more of your money. This can also be helpful if applying for financial aid for schools. A great vehicle for 401k and 403b consolidations, leading to sometimes more investment choices and sometimes professional management. That could be a great option too. So be sure to compare the pros and cons and also compare costs. Now, do you have a collection of 401ks or 403bs that you're trying to keep track of? I'm helping to put together a list for you, all the accounts, and see how each are invested. Many times when we look at the accounts as a full picture, we see that there's an oversaturation of one asset class or another. This can put your money at unnecessary risk. Now, reach out for a free discovery call and we can discuss getting your financial picture together. So thank you for joining us for this episode of Widow and Wisdom, your wealth edition, where your mindset and money matter most. Be sure to like us and share us with your friends and loved ones, and follow us on Instagram for more practical money talks for families in transition.